to all of you here. So today in this new video we are going to talk about an interesting topic that's regarding stock markets. Currently, if you take Sri Lanka, with the economic issues slowly dying down, with the domestic debt restructuring or debt optimization announcement being put out to the market, interest rates have been coming down. That means our stock market is being picking. You would have seen it recovered from 8,500 points to 10,000 points, now a bit more closer to the 11,000 points. Now, in this background, a lot of you must have got advisors saying, why not shift your investment to the stock market? It could be a good advice, but as a prospective investor or as an investor whose already money is invested in the stock market, you need to have certain basic discipline or know certain guidelines to manage your investment when it comes to the stock market. So in this video, I'm going to explain you those guidelines that will be really important to manage and make sure your investment is saved while you try to get the best return. Okay, so let's get into the video. The very first guideline I wish to remind all of you is you need to know your risk limits. You need to know whether you're willing to add more risks to your portfolio, you want to invest in more risky assets, or you want assets or shares which are low in risk. Having this clear understanding will help you in choosing your assets or choosing your stocks. A lot of the investors don't have a clear idea on their risk appetite or the risk limit. Because of that, when so many other outsiders come and influence you, you easily get nudged towards their advice without thinking. So, as a basic principle, first understand your risk limits. Am I comfortable with a high risk investment or am I comfortable with a low risk investment? Of course, this risk limit decision comes with your amount of investment, your amount of saving, all that. If you take a scenario where, let's say, you're trying to put 100% of your savings in the stock market, at that point, the ideal risk limit for you would be a low risk limit, where you try to play with your money by investing in low risk assets. Yes, that will yield you low return as well, but at least through this, you are sure that your initial investment or your principal is safeguarded. If you put your 100% of your savings in high risk asset, there's a high chance of you losing even your principal investment. So knowing your risk limit is going to help you when you're going to filter out which stocks you're going to invest in and which stocks you're not going to touch. Next, we suggest you to always think long term. One of the big drawbacks that we have in an economy where markets are picking up is a lot of rumors, a lot of fake advisors coming in, and a lot of speculation. Now, all this to an informed investor, to an experienced investor, he or she would easily recognize. But to a person who's new to the stock market, this information will be like a carrot, pushing them to make high and high investments to the stock without thinking any further, trying to get the best return at the quickest time possible. What we suggest you is not to get misled by these fake information or these fake guarantees of return. Always think long term. If somebody is suggesting you a share, just to say that, look here, after in 2 months time, some investor in India is coming to buy this company, so why not buy this share now itself? If somebody is giving you this false information, try to first understand whether that information has any validity. Study about the company. I know it takes time, but if you are going to invest your hard-earned money, take some time and understand about the company. Is this company worth enough for somebody to come and invest? Is this company's net book price of this per share, is it higher than the market value? Is it lower than the market value? If it's lower, then the gap, can that gap be for goodwill? Can that gap be guaranteed? Can it come down? Like that, ask questions so that you can save yourself from this false information. And when you make investments, make sure that you are able to make that investment and get a return at least for about 3 to 6 months time. These quick return earning investments are not recommended. It might work for you 2-3 times, but not always. And when it doesn't work for you, it would hurt you very badly, because you might not just lose your return, you might lose your entire money in that game as well. So be very careful. Next is to diversify. Yes, 100% your investment should not be invested in just one company or just one particular industry. First, try to diversify your investment across different asset categories. You can invest in shares, you can invest in debentures, you can invest in bank products. Have a clear demarcation on what percentages you are going to keep in these asset categories. If you are a person who has a low risk limit, then of course you could have a high percentage of your investment in maybe bank FDs and debentures and a relatively low percentage in share. And if you are a person who is comfortable in handling risk, you can maybe go for a 50-50% of a diversification. If you are a person who would love to take risk, then yes, take up more exposure in the stock market while having a reduced exposure in the debt market. But in some way, without putting 100% of your money in just one category, still you have diversified by making your investment across different asset categories. Not only that, even when you're coming to the stock market, don't just put your money in just one company or one sector. Make sure you put your money across good shares, that's the first category, but also across good shares in different sectors. Now, if you take a lot of fund managers, how they practice this is in their investment policy, they say for one particular company they can't invest more than 20 to 25%. The main reason is that so that they are able to cap their exposure. In case something goes wrong, they are able to still cap their loss at just 25% of the portfolio. And another reason that they have this diversification or these limits or exposure limits is that they are able to tap into other companies who also have good potential to grow. Now, a very good example for this when it comes to the Sri Lankan context, if you take last year during the economic crisis, what happened? Almost all the bank shares crashed. They came down to very low prices. So let's say you are an investor who put all of your money in the banking sector shares. Then your share portfolio would have been reduced to a very low amount, would have come down by a very long amount, very huge amount, and that reduction would have stayed for a very long period of time. Until now, you would have experienced that loss. But let's say through this, when you put your 100% of your investment in the banks, and through this you left out the opportunity to invest in power and energy, who benefited out of this crisis. So if you take companies like Lanka IOC, during the power and the energy crisis, the company thrived. They were able to record huge profits. So if you haven't diversified, you are not only going to lose your money in a sector which is having a very drastic reduction in prices, similarly you are losing out a good opportunity in another sector where you could have earned somewhat of a return. Now, if you had split your investment as 50% banking, let's say 50% power and energy, then only half of your portfolio would have witnessed this reduction, while the other half would have witnessed a phenomenal growth. So on average, you would have recorded only a minor decrease in your portfolio or a very good gain in your portfolio. That's why diversification is important. Now, for you to decide on diversification, you of course need to have limits to the sectors that you're trying to get into, and make sure, however enticing that offer could be, not to go and invest in the same related companies or in the same sector company. Diversify. If you're investing your money in, let's say, import related businesses, make sure you have a similar or at least somewhat closer to a exposure to export related businesses as well. So when one part of when imports pick up, yes, of course exports might struggle, but at the same time when exports pick up, you're able to manage your portfolio. Getting professional advice. Now, in the stock market, always make sure to get your professional advice from your stockbroker, and of course your stockbroker will have access to research report. Either it can be in-house or outside research reports. Go through them and make sure your information comes through these credible sources. That's why we are saying to get professional advice. Of course, you would get advice from a lot of WhatsApp groups, maybe from Twitter accounts, maybe from Facebook groups. You could of course read it, but do your background check to see whether that's true. And don't forget to always keep in touch with your stockbroker to know what's happening in the market, to see how the market is moving, and get your intel from that stockbroker in making your decision. Studying company fundamentals. This is the biggest principle that you need to have. A lot of the investors who are shareholders of several companies, they still don't know how their company is doing, what's the balance sheet size of their company, whether they are incurring a profit, nothing. As long as the price moves, as long as they get a dividend, they're happy. But studying the company fundamentals will help you to really understand whether you're putting your money in a company which has a good future or in a company which might be good at the moment but is going towards a doom. So you have to study the company, know what they're doing now, know what their plans for the future, know their current status, especially the financial health, so that you can really have confidence to say that, look here, this company can actually run very well in the upcoming future. So that's why we say make sure your thinking is for the long term. Finally, most important message I want to say, don't panic in a crisis. You would have got certain adverse information or a sudden drastic crash that's coming your way. What we recommend is not to overreact. Don't just take snap decision. Understand what's happening in the market. Of course, talk to your stockbroker to see whether this phenomenon is going to continue or not, and try to make your move when the market is stabilized, because in that way you are able to make sure your portfolio, your investment doesn't have a drastic loss. So don't make panic situation or snap decisions. Make sure you follow all the guidelines we just discussed a while ago. Those will help you to handle this panic or stress purchasing or stress selling. Through that, I'm sure you could get a very comfortable return in any stock market. Thank you so much for listening in. Subscribe to Learning Business for more videos.